All right. I'm gonna be doing a debt investment problem. So on January 1st of 2026, Horizon buys $100,000 of 8% bonds for $92,418. The bonds pay interest annually every December 31st and mature in 5 years with a effective interest rate of 10%. On December 31st of 2026, the fair value goes up to 96,000, and then in December 31st, 2027, they drop to 90,000. Um Essentially we're going to be comparing how certain things change across the three methods for debt investments. Um and before we do that, I am going to make a quick amortization schedule just to kind of visualize how the journal entries we do down here look, or I guess relate to the schedule. You'll see some similar numbers pop up. And so to start, our beginning balance, we know we bought the bonds for 92,418. So then for interest earned, we're going to be using the beginning balance of the current year times the effective interest rate. And then cash received, this is like the coupon payments, principal payments. And so for this, we're going to be using the face value of the bond times the stated rate. And then our amortization can be calculated by taking the interest earned minus the cash received. And then our carrying value, our ending balance, will be the beginning balance plus our amortization. And I'll go into more detail in a second when we get to the journal entries. I guess explaining more about this right here, this number. So our beginning balance is the ending balance or carrying value of the previous year. And so if I did this correctly, we should be able to just copy and paste all the way down. And then accounting for a little bit of rounding, we do reach $100,000 at our ending balance. So moving on to our journal entries. This is going to be the purchase of the bonds. So again, we bought the bonds for 92,418. So cash is going out the door. That's our credit, and then our debit is debt investments. This is our asset. This is basically the bonds themselves. We gain bonds. This does not change across the three methods. So as you can see, they're all the exact same. And so now moving on to the interest and the amortization. Now we're going to be receiving our first coupon payment. So that's going to be our, well, in this case, 2026, the number is the same here, but the beginning balance times, I'm sorry, no. Our coupon payments are based on the face value. That's what I was saying earlier. So we're going to take the face value of the bonds times the stated rate. And then our interest income, this is what I was trying to do just a second ago. This is going to be our beginning balance of the current year, which is the same as the purchasing price of the bonds, times the effective rate. And then we can just plug this number here for our debt investments. And if you look, you'll see these are the exact same numbers in our amortization schedule. However, debt investments is under a different name here, right? So basically, we're increasing the value of our debt investments, right? Because we debited it here and we recorded the bonds originally, and now we're saying they went up by another 1242 to get a carrying value of 93,660. And the reason for this is because we had a discount, right? We bought the bonds for $92,000, but the face value is $100,000. There's about $8,000 there that we got it for cheaper. This amortization is reducing the discount, which is increasing the value of the bonds. So all we're doing is just recognizing that. And as a result, our debt investments gets a debit again. Recording this does not change again across all three methods. It's the exact same. And then we move on to any adjustments for fair value, unrealized gains, losses. For the held to maturity method, this does not apply. The reason for this is because the intent here of the company, or in our case Horizon, is to hold the bonds till maturity. They're not going to be selling the bonds in the market or anything like that, so fair value doesn't matter here. We don't care what the market says it should be going for, any dips or gains, and so as a result, we're just going to worry about the carrying value with amortization taken into account. Because again, we're holding it to maturity, so the contract of the bonds itself is really what matters. However, available for sale and trading security both value the bonds at their fair value. And we'll go and do the calculations first. What we're going to do here, we're going to take, as we saw here, the fair value of the bonds rise to 96,000. So we're going to take 96,000 and subtract it from the carrying value in 2026, right? Our ending balance in 2026. And we're going to get $2,340 as our difference. So we had a gain here. Our carrying value was 93,660, but we need to bring it up to its fair value of 96,000. And for the available for sale, we're going to list this under other comprehensive income, which is different from the trading security, as you see, is under the income statement. And the reason for this is because with available for sale, the company's intent is they might sell the bond, they might sell the bond, and they might hold it till maturity, right? They're like in the middle still. They're trying to wait to see what's the best course of action for them. And because of this, we can't just say this increase in the value of the bonds, fair value of the bonds, we can't just call that net income, because if the company doesn't sell the bond yet, then like they can't recognize that, right? It hasn't happened yet. Their intent isn't to sell the bond yet as well. That's another key part, is because the intent isn't necessarily 100% to sell the bond. We can't call this income yet. We can't list on the income statement. Now, say this happens, this exact scenario, we get this calculation for the other comprehensive income statement, and then they do sell the bonds. Well, then we would convert this in another entry later on to regular income, because now they've sold it, and the intent was to sell it and it was sold, right? Versus the trade security, the intent 100% is to sell the bonds relatively soon. And so that's why we can go ahead and recognize this as income, because the company's intending to sell the debt anyway. The debt investment anyway, relatively soon. So it makes more sense to say this is income. And so then moving on to 2027, we're gonna do the exact same thing here. We're gonna recognize our cash received from our coupon payments. So we're gonna take the face value of the bonds times the stated rate of the bonds. And then for the interest income, remember I was saying these two numbers are the same, but that's just because it was the first year. Now that we're in 2027, our beginning balance or ending balance of the previous year is now 93,660. So we're gonna take this number and multiply that by our effective rate. And then again, we can just do our plug here. And we see once again that these numbers are the exact same as the numbers in our amortization schedule, right? Once again, this is the same across all three methods. Now, still can't apply any fair value adjustments in the held to maturity method, because we don't care about fair value. We only care about the carrying value. Now, something that changes for the available for sale and trading security methods And this next year is the fair value adjustment account has a balance in it now. It has a balance, or a debit, sorry, of $2,340. However, we want it to have a ending balance because our fair value drops considerably. It's 90,000 now, and our carrying value is 95,000. So we need to bring our value down to its fair value for these two methods, and we need to reach this credit balance of 5,026, right? So in order to get to that, we actually have to have a credit of $7,366 for our unrealized gains or losses / fair value adjustment. Because again, we're playing catch up from the previous year's adjustment, jumping from a debit all the way to a credit of 5,026. And so then here we're decreasing our value of our debt investment, and so we're gonna have an unrealized holding, in this case loss, as a debit, and then our fair value adjustment as a credit. And this is the same across the two methods. However, again, in the available for sale method, it'll be under other comprehensive income, and then under the trading security, it'll be under the income statement. And that's the journal entries. That's the journal entries for the purchase of the bonds, recognizing interest and amortizing the discount on the bonds, and then recording the journal entries for fair value adjustments. And then for my real world example, we're going to Edgar, and we're going to be looking at NVIDIA. So if you go to their accounting policies, I believe, let's see. Yes. So under their accounting policies, they do disclose that we classify our cash equivalents and marketable securities related to debt securities at the date of acquisition as available for sale. So they are using, goodness. Okay. They are using this method right here, right? Well, I guess really this. Available for sale. They might be selling the investments. They might be holding on to it. They're not 100% either way yet, right? And again, as I was saying earlier, they're reported at their fair value with the related unrealized gains and losses included in accumulated other comprehensive income or loss, like I was saying earlier. And so yeah, as you can see, this happens in the real world, and they do disclose it. This was under the, let's see, their Form 10K, and yeah, that's about it.